Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I am Darshan Mehta. Let's welcome our experts on the show. Joining us today are independent investment advisor Sharmila, Joshi, as well as Vivek, Mavani, as well as Vineeta Sharma of Narnolia Financial Advisors. Thank you to all of my guests for joining me. Today on Hot Money, we'll discuss PC Jewellers. That's had a good run. It's up almost 20% in the last two trading sessions. The stock has more than doubled actually from its 52-week low in October. So we discuss what's causing the rally in the stock. We also ask our analysts whether they would like to accumulate any of the MNC Pharma stocks. Counters like AstraZeneca Pharma seem to be doing extremely well of late. So that's something that we will speak about. We asked them whether the worst is over for Vedanta. Vedanta has come under the heat a lot because of issues as far as corporate governance are concerned. But is that now factored into the price? And finally, the new listing that happened on the bosses today was Metropolis. It's up almost 80 rupees from the listing price. We ask analysts whether one should take a bet on the stock or not. So that's the stocks that we will discuss in trade today. But the first stock obviously is PC Jeweller. It's the stock of the day. It's up almost 9% in today's trade. It's been rallying significantly. So we asked them whether they know what's causing the rally and what's the outlook for the counter. It's actually more than doubled in the past 6 months. So with PC Jewellers, quite a rally. The drop was significant. The rally has also been quite impressive. What's your stance? Are you aware of something that's causing this rally? And at this level, should someone take a position on PC Jewellers?
Well, just to put things in perspective, I mean, the rally, of course, I mean, it's doubled from its low point, which was whereabouts of 48 or 50 rupees just a few weeks ago or a couple of months ago. It also needs to be seen in perspective. It had fallen 90% in the last 12 months from a highs of about 580, 590 to as low as 45 or 50. I mean, a 52-week low absolute point is 46, what your stock exchange seems to be report. Now, what's caused this rally? I can only think of two things. One is the sell-off seemed to have been overdone over the last 12 months. From a valuation point of view, for whatever numbers, I mean, people give various opinions on the numbers itself, but if you believe the reported numbers, it had fallen to ridiculous valuations that probably prevailed 5 years ago or maybe even earlier than that. Second reason I could attribute is a sharp rally in Titan on back of almost 20% growth in the jewelry business, having a rub-off effect on PC Jewellers as well, because finally even PC Jewellers, the whole rally over the last or rally between 2013 to 2017 was on back of a shift from unorganized, unbranded jewelry to branded, organized, large corporate jewelers. I mean, that theme still continues to play out, and Titan seems to benefit massively. Now, the whole fall of this 90% seemed out of ordinary because of one disastrous transaction that they got into of investment of 200 crores in Vakrangi last January of 2018, which sort of spooked market participants given the background and credibility governance issues which Vakrangi had, and hence people started doubting PC Jewellers as well. So from a valuation point of view, high point at about 40 times earnings last January, about 25 times EV by EBITDA. It had fallen to almost 5 times EV by EBITDA this January, just 3 months ago, and perhaps about 9-10 times earnings. That itself undid all of the 5-year stock price performance between the last time it was trading at 50 rupees was way back in 2012 or 2013. It undid 5 years of returns. It's probably value buying at lower levels, which has resulted in this stock price movement. Whether the rally can continue from these levels needs to be seen if the company delivers consistent growth over the next few quarters. What initiatives or efforts management takes to build that credibility back and the trust factor, because today, I mean, most market participants don't seem to believe the numbers. And that seems to be the consensus opinion. Brokerages have suspended research coverage. Now, what does the management do to win back the confidence of the market? Participants will determine whether the rally will continue.
Okay, that's the view that's coming in from Vivek. Sharmila, what's your sense on PC Jewellers? What would you advise?
Yeah, so precisely, I think, as Vivek outlined, the trouble has really started in July last year after that whole Vakrangi thing came out and the auditors resigned and so many corporate governance issues. So there are two things. One is that, this is typically a rule that applies to a lot of stocks that lose 90%. They sometimes swing back. So I think, part of the rally was because of that. And I think part of the rally is because of this Carlina buying some shares into it. And, the market always gets excited that if a big name is buying into a chunk of shares, then maybe some things are improving for the stock. But very honestly, I think given the corporate governance issues, also, in terms of earnings, you haven't really seen any great recovery there. This is to be viewed against the background of Titan, which is giving better numbers and quality balance sheet, etc. and a lot of shift over there. I would continue to stick with Titan and really give PC Jewellers a miss.
Okay, what about you, Vineeta? What's the sense that you are getting in seeing the rally?
So just to add a little more on the background, like PC Jewellers, obviously because of organized retailing, you have two important good companies. One is Titan and the other on the brand positioning as PC Jewellers. But in the last, since FY18, if we see the balance sheet of PC Jewellers, so in the first half of FY18, the receivables were around 1300 crore, and that shot up to 1700 crore. So incremental sense of debtors were coming out of incremental exports. So any extra export was getting translated as debtors. Inventory shot up by 25%. So the balance sheet positioning of PC Jewellers had really worsened. And even on the debt front, so they had around 800 crore of debt in some 16-17, which is currently in the last half, we can see it's around 1700 crore. So that debt positioning is also increased, maybe because of the working capital requirements. Plus on the management side, they have been discussing about more of franchisee stores and settling down of own showrooms. So what kind of management has been speaking, and then how the company has been performing. So initially exports were around 45% of the total books. Now export is around 16% of the total books. So there has been a lot of volatility in the business model itself. So exports coming down in 2-3 quarters. So even if somebody has to get down the exports, it will go in a very phased manner. It will take some 2-3 years to get down to that level, and it was just very sudden. Also also on the debt front, they are saying that they'll reduce the debt and stuff like that. But then there has to be a little bit stability on the business before investors gain more confidence on the company.
Okay, so that's, I think, the consensus view that you're getting in on PC Jewellers. Obviously, the knock of 90% because when Vakrangi invested in PC Jewellers, that was a big fall, and then when both the counters managed to fall significantly, I think it needs much more clarity over the next few quarters what they do before any kind of investment should be made. That's the view that our analysts, our guests are indicating at this point of time. The other pocket actually which seems to be doing well is the MNC Pharma space, and they seem to be outperforming some of the traditional generic companies or even the hospital company. So counters like AstraZeneca Pharma has been doing well, Pfizer, Merck, all of them. We asked our guests whether they like any of the MNC Pharma stocks in the rally. That's the view. Sharmila, anything in the MNC Pharma space that you like?
Yes, as you mentioned, the MNC Pharma space is doing much better than the Indian companies, and I think you've done a very good story on this. I remember a couple of months back. I think people should go and see that, and the reasons are very well outlined there. But I think, as you outlined in the story, they're doing well for different reasons. I think within the current, to answer your question specifically, I think I like GlaxoSmithKline Pharma. Okay. I think here the valuations are obviously quite expensive. It's not a cheap company from that point of view. But the results are improving. Okay. So that's the reason why I like the stock, because the results have shown a definite improvement, and you could see upside from these current levels. So I would go with GSK Pharma. Okay. So you're basically on the financials, you believe that they will be able to continue the run rate that they are growing? Yes, their earnings will improve, and hopefully the lower margin picture will also sort of get adjusted as their earnings, the revenue shows that uptick. And this is one stock which really a lot of people said sell because of the valuations, but their revenues have shown that growth in this last year. So yes, I think this is a stock that I like.
Okay, Vineeta, anything that your house covers actively in the MNC Pharma space and that you are telling your clients to buy?
So we're not covering any of the stock actively. So, but yeah, there are companies in our soft coverage. And if we look at MNC Pharma as such, most of them are famous for their OTC sales, the kind of product positioning they have, and also on the chronic disease side, where they have good positioning. Also, I would say on some of the vaccine side. So they have a very unique product positioning for most of the MNC Pharma. And if you look at Sanofi, if you look at valuations, so valuations have always been on the higher side. Glaxo, as you said, is trading around 53 times. Sanofi or all these are trading at Abbott, they are trading around 35 times earnings, FY20 earnings. So valuations definitely are on the higher side, but the balance sheet positioning and very light business, I would say, is what they are having. I think going forward, companies whose, because there is a lot of, now the competition is growing. Even for Abbott, if you have Thyronorm or Combiflam for Sanofi or Gelusil for Pfizer. So there are a lot of competitions on the product side. And I believe companies who are coming up with more product launches should be a better gainer. So our preference would be on Sanofi.
Sanofi.
Yeah, Sanofi I think is a good bet, and the kind of growth it has delivered, very consistent in its performance, and not much volatility in the top line or the bottom line.
Okay, Vivek, what's the sense that you have on MNC Pharma companies?
Well, I'm also positive on the MNC Pharma space. Just to give a perspective, that most MNCs are focused on the domestic market, and while most of the news flows and attention of the market participants is focused on the big Indian pharma and their overseas businesses, whether it's Sun Pharma, Lupin and Cadila and Vocart, one tends to often forget that the domestic Indian market is also growing at high single digits. Certain segments within the pharma space, especially the lifestyle ones, have been growing at double digits as a sector as a whole, and MNCs are basically focused in that space. And it's a very interesting space because, like consumer, it's a secular growth story. Cash flows are very healthy, return on capitals are very high, and that's what most multinationals tend to have. My preference is also for GSK Pharma, GlaxoSmithKline Pharma, for 2-3 reasons. I'll add to what Sharmila has mentioned, that yes, valuations look rich, but what stands out in GSK Pharma is almost 1,000 crores investment that they started doing sometime 2 years ago, which should now start yielding results. Much of the investment would have been done with, and from current year onwards, we should start seeing the results in form of higher revenues. This is for a large investment in manufacturing facility in Karnataka, as well as upgradation of the other manufacturing facility near Nasik, which would be backed by new product launches also for the domestic market from their global product portfolio. Now, just to put this 1,000 crores in perspective for two things. Last year, their gross block was 250 crores, and this is after 100 years of being in business in India. 100 years being in India and 250 crores of gross block and incremental 1,000 crores of investment over 2 years, one can get the sense of the size of the investment that they are doing. And this kind of size doesn't come without serious commitments in terms of the serious determination to grow the India business. Yes, last 10 years, they have probably struggled even to grow in double digits. Most of the years they have grown in single digits, but it's a very strong balance sheet, which is debt free. A huge amount of surplus cash and cash equivalents investments on the balance sheet. So the entire 1,000 crores is by internal accruals, being funded by internal accruals. So even after this investment phase, it will continue to be a debt-free company and throwing up huge amount of free cash flows. And as Sharmila mentioned, performance now has been improving. So although historic numbers may look, the valuations may look rich, I think if we look at the growth going forward, it seems a reasonably good bet to take. A disclaimer, we have an investment in GSK on behalf of clients.
Okay, that's the view that's coming in. So the two stocks that were discussed actively on the MNC Pharma space was Sanofi as well as GlaxoSmithKline Pharmaceuticals. So that's something that you need to watch out for. The next stock we want to talk about is Vedanta. Now, the counter has fallen significantly, and one of the key reasons was the corporate governance issues that was raised when the promoter group Vulcan Investment invested in Anglo American. The market didn't like it. The counter was corrected significantly. It's down 36% on the year, and as metals probably fourth quarter previews do indicate that global commodity prices have come off significantly. So probably there won't be much steam left among some of the some of the metal stocks. Let's talk about Vedanta in particular. Is the worst over? That's something that we want to ask our guest. Vineeta, I'll start with you. Vedanta, it's come off significantly. Firstly, do you all have active coverage, and what are you all recommending your client? Is it a good time to now start nibbling into Vedanta?
So we have active coverage in Vedanta, and presently we are neutral on the stock at the current prices also. Considering one is the capital allocation strategy of the management, which is not very comfortable. Also, if you look at the business side, it's a big conglomerate. So for an analyst to be very specific, there is oil and gas, there is copper business, there is lead, aluminium, zinc international business. So it's a huge conglomerate, and to be very right into what you are suggesting to the client, it becomes a little tricky because of the kind of business it handles. Also, the copper smelter that is down, so it's not functioning. The Goa mine, that's not working. So ex-copper, we are expecting around 7% top line growth. Margins are not improving. The company has recently, sent a mail for some kind of a debt restructuring, but that is very small in context to 55,000 crore of debt that it has in books. So I think it's better to stay neutral on the stock right now, also because of the prices that have fallen. So zinc prices or even the aluminum prices. So I don't see a lot of headroom right now for Vedanta.
What's the target that you all have in your coverage?
I think we have 179 as a
so pretty much where the counter is right now.
3.5 times EV upon EBITDA for FY20.
Okay, Vivek, do you share similar concerns, or would you be a buyer in Vedanta?
Well, actually, I mean, taking a call on Vedanta is basically taking a call on global metal commodities, which itself are linked to global macroeconomics in terms of whether the world is slowing down or what's going to happen in China in terms of demand, supply, so on and so forth. So now I neither track nor do I possess any expertise or know-how in tracking these multiple global variables as far as metal commodities are concerned. So I don't really track Vedanta from that point of view. Now, two things that I would still like to add. Hindustan Zinc, which is a subsidiary of Vedanta, which is a pure zinc company, has got a small business of silver also, but earnings come from zinc. That probably is an interesting company, given that it's a debt-free company, would have close to 20,000 crores of surplus cash sitting on the balance sheet, which at some point of time is going to be paid out as dividends. Importantly, 26% is held by the government, so if the government needs the dividend and the parent company Vedanta also needs the cash which is sitting in the subsidiary. So at some point of time a huge dividend can be expected from Hindustan Zinc, while the zinc cycles if one were to look at over a 5-10 year period have relatively been much steady than compared to crude or oil and gas or any other commodity cycle. So I would be more positive on Hindustan Zinc, not much view on Vedanta. Otherwise, really no comment to make.
Okay, what about you, Sharmila?
Well, I think for both the reasons which have been discussed. One is, of course, that whole issue with Vulcan, which I think has not gone down too well with them wanting to buy that US whatever. And I think even just combining it with this fact that you are seeing the slowdown globally, and I think China is not going to sit by quietly and wait, for this situation to sort of get worse for them. So I think from both aspects, I think Vedanta is not a stock I like. In fact, I've recommended a sell on it on this very show, I think a couple of weeks back. So to my mind, overall metal space is dicey, and within the metal space, Vedanta is the stock I don't like.
Okay, so that's the view. I think consensus negative view that's coming in. Hindustan Zinc is something that you can look at. That's something that Vivek spoke about. And finally, the last stock we want to talk about is the Metropolis IPO that happened today. The company got listed, decent premium. It's up almost 10%, 960, 880 was the issue price. Vivek, if someone obviously didn't get shares in this thing, it's trading at the same level it listed at. Should they take a bet on Metropolis?
Well, certainly it's a buy on declines story for the next 5 to 10 years, rides on the same theme that is applicable for a large number of sectors where there is a transition happening of business from unorganized, unbranded, small scale to branded, organized, large corporate. I mean, that kind of consolidation is happening, and it's happening in healthcare diagnostics as well. So today, if we look at corporate branded diagnostic chains, whether it's Metropolis, Thyrocare, Dr. Lal's, and maybe you have a couple of more, all of them put together don't even account for 10% of their total spend on diagnostics. And there's a huge fragmented market, including hole-in-the-wall pathological labs all over the place. So over a period of time, quality concerns, greater spend on healthcare, greater compliance requirements on part of small labs, the shift in business will certainly happen in favor of large labs, and Metropolis, including Thyrocare. I mean, it's not that Thyrocare will not benefit. Metropolis would be one of the beneficiaries. Two other things which work in favor of these large labs is, one is increasingly these pathological labs, I mean pathological business or this diagnostic business is getting more and more automated and more technology intensive, where the manual intervention of a pathologist actually doing those tests, I mean, is getting done away with. So the greater investments in technology, equipment, automation, the larger ones stand to benefit. Okay. Third larger trend is regulation, which would put a certain minimum standard in terms of quality, in terms of manpower, etc. All of which benefit. I mean, the trend is in favor of Metropolis.
Okay, that's the view that's coming in on Metropolis. Sharmila, what's the sense?
Well, I wouldn't buy because, honestly, I think even at the IPO, I wasn't really very positive because I don't like these OFS sort of, issues where you're not really going to use the proceeds for any expansion and you're actually just providing an exit for an investor, and then you're doing it at a valuation which is where you can buy a listed play which has a better strategy to my mind. So I think my preferred, I'm positive on the diagnostic space, so I think my preferred play within that space would be Thyrocare.
Thyrocare, that's just something that you would bet on. Despite, it wasn't growing, they haven't been able to grow at least for the last few quarters.
Yes, but I think that, the sort of their strategy going ahead and their prospects given the space that they're in, this is a stock that I prefer over definitely Metropolis and the other listed plays as well.
Vineeta, what's the sense on Metropolis and the diagnostics?
We are also neutral on Metropolis, and considering the valuations that it has come out with, so valuations, I think it's almost at par with currently at par with Lal Path Lab. And the business itself and the business model is very encouraging, and I think there's a great future for that. But at the current prices, I don't think it's a worthwhile, because, and plus in the immediate, in a very short period of time, we can see a little bit, some pricing cut, because government has also come up with certain, cap on the diagnostic, certain diagnostics. So they have listed down certain diagnostics on which there should be price cap. So volume they are expecting because of acquisitions. So I think all the cash flows will be used towards acquisitions. So later on, say 5 years hence, when all the acquisitions and things are done, there will be a dividend play story. Somebody can have it in their portfolio, but I think it will give a better price to enter. Okay,
so that's the view that's coming in on the final stock, and that was Metropolis. We have the management with us, but before we go to the management, let me thank all my guests for coming in. Vivek, Vineeta and Sharmila, thank you so much for coming in. Let's hear what the management of Metropolis had to say. I spoke to them in the morning. This is what they had to say.
I think IPO, while obviously everybody looks at it as it's a very important milestone for the company. I think it's a recognition of of how far we've come. Business stays the same.
Yeah.
And at the end of the day, we've always focused on making sure we take care of patients, take care of our stakeholders, our investors, and that will continue as we speak. From a competitive standpoint, I think, I don't think anything is significantly different. I mean, I think a few years ago, we saw a little bit of funding come into the industry, either from private equity or from corporate groups who were interested in getting into diagnostics. And that created a little bit of volatility in the industry because suddenly there was a little bit more capital in. I don't think it was ever very crazy. But I think some of that has streamlined now because I think people have realized that this is not a business where capital is the biggest differentiator.
Okay.
In this business, actually trust, your brand is your biggest asset. And holding that, nurturing that and making sure that on a daily basis you're doing what you're supposed to do is the most critical part of building this business, which is much harder to use than capital.
Okay.
So I think we're in a good space. I think we're in a strong leadership position. And I believe we're only going to grow from strength to strength.
So last time we spoke, we spoke extensively about how, the unorganized market is almost 85 to 90% is a big problem. And, we spoke to other diagnostic players and they also said that, certain norms that apply to you don't apply to them. And that's why they are able to pass on a lot of discounts. The other aspect which we didn't discuss is hospitals, because they as a part are also now getting into diagnostic, into testing. Do you see that as a major competition going ahead? Would that be a threat for diagnostic labs as such?
See, again, hospitals are experts at treatment.
Yeah.
We are experts at diagnostics, and that's why our brand positioning is also the pathology specialist. It's like asking me tomorrow if we go and start hospitals, does it give us an advantage to be in the hospital space? The answer is no. We understand healthcare, we understand diagnostics. The same way hospitals are really clued in on treatment. So we don't really are not experts in each other's areas. If, of course, somebody decides to get into the diagnostic space, then for them it is like anybody else getting into the diagnostic space. It's a new business. And they'll have to learn the dynamics from scratch.
What about the two aspects? I think we spoke that the B2C business seems to be doing stable, people coming in. How tough is it operating in the B2B scenario at this point in time?
See, the B2B side has two pieces of it, two product lines really. One is a semi-specialized product line and one is the specialized product line. In the semi-specialized product line is where you see basically mostly automated tests which don't have too much of expertise and scientific expertise requirement. So you see a lot of the new companies that have come into the industry have come into it competing in the semi-specialized space.
Okay.
We actually focus more of our attention on the specialized space where we are actually there for people when they're trying to figure out whether somebody in their family has cancer, whether something really serious is happening. In that situation, people are not looking at the cheapest price. They're actually looking at who's got the right quality report because they want to treat their family member. So from that perspective, I don't see the B2B as being something which is really eroding our value. In fact, for us, it's enhancing our value.
What about volumes? Are you looking to play the volumes game in this segment, or are you looking to play the pricing game?
We don't believe, we believe the volume and the pricing game actually goes together. We believe there's a third part, which is the part that we are in, which is moving up the value chain segment. So I think for us, while of course a healthy part of our revenue growth will come from volumes, some of it will also come through a change of test mix. Because like I said, Metropolis is known for the credibility and the specialized tests, which tend to be at a slightly higher price than the normal routine tests. And as we see more and more of this mix changing, we will actually see our revenue growth also increasing because of that.
Okay. What about capex? Because the IPO that happened, money will not come in. Are you fully funded to go ahead with your capex, your expansion plans? You must be looking at more laboratories. You must be looking at more touch points for the patient. Are you fully funded to go about that?
We are. So actually, we've been very comfortable with our internal accruals now for a long time. And we are generating cash. We have almost a 50% EBITDA to cash flow conversion ratio. So therefore, we've had enough money not only to take care of our internal capex, but also to do small bolt-on acquisitions. So therefore, yeah, internal accruals wise, we're fine.
What about financials? I know you can't give forward-looking statements, but generally we've seen that there has been a slowdown as far as the run rate of top-line growth is concerned. At least we can look at the listed players that are there. Is that something that you're seeing, that the top-line growth probably won't be the same as it has been over the past few years?
Actually, for us, the top-line growth that we are seeing in 18-19, for example, the numbers also that we've given out in the RHP has been higher than the top-line growth we've seen in the last few years. So actually, we are in a slightly different stage because we are in a growth stage in our business. I don't want to comment on the competitors, but I think we are in different stages. So therefore, really for us, we feel that the growth rate that we are currently seeing, we believe would be very sustainable.
And how do you see margins? Do you see them stable? Do you see, and what exactly are you looking at, since this is a competitive space, that margins can expand going ahead?
See, for us, I think if you look at it from a 3-year perspective, we will largely see our margins being around the same. There is going to be some operating leverage that will come out of the B2C part contribution, our business really expanding, and there will be some operating leverage that will come from there. But we are also reinvesting that operating leverage into growth and really expanding our market share. So therefore, as we believe that we'll have over a 3-year period very sustainable margins.
What is the meaning of this